What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
Michael, there's a lot going on in markets. You and I were just out meeting clients, and there's one thing everybody seems to want to talk about because it's the driving force in markets today, and that's oil. I wanted to just open it up to you. What are your thoughts? What are you telling clients?
The funny thing is there is a lot going on in markets, but really since the spike in oil prices last week, there's really one thing going on in markets. And we've described the onset of this move in oil as creating a one variable stock market. And what we mean by that is historically, when you get these exogenous shocks in things like oil prices, or even big spikes in interest rates, or big spikes in a president talking about raising tariffs, you get this one variable market, and the variable du jour tends to drive things. And it tends to create a lot of correlation, really elevated period of correlations within the stock market. And in today's context with oil, you get a very binary backdrop for leadership, where obviously oil and energy stocks are the winners with a handful of other defensive parts of the market. And then the losers are clearly a lot of the higher beta, lower quality, rate sensitive, or oil sensitive names in a bad way, negatively correlated, until the price of oil starts to settle down. So our view has been that we're going to be in this one variable backdrop until we see oil prices stop rising. Because of course, if oil prices keep rising, the situation is getting worse. And what happens historically, and we're beginning to see this, when a situation gets worse, people start to extrapolate out farther and farther the negative implications of this backdrop. And now the good news is, with respect to oil, it's mostly been in the front end of the curve thus far. We have this extreme backwardation going on in the oil market. You've got the front month WTI closing on Friday just above $90. And when you look out, let's say about a year, the oil price is $66. If we look out what the market's pricing in for June oil, we're at 78. So that's higher, but there's a steep, the front of the curve is extremely steep and downward sloping, going out about 6 months or so.
Why isn't the market down more?
Yes, if you look at year to date, the S&P is only down 1.54%. The NASDAQ's down about 3.75%. The Dow Jones is down 1% year to date. So obviously we started from slightly higher numbers. The S&P 500 cap weighted index never really had any material upside to date. So yeah, the market's not down that much. There are many stocks down underneath the market, of course, that are down quite a bit. And I think there's a couple of reasons for that. One, when you get these types of exogenous shocks, investors typically sell a lot of their lower quality, more speculative names, which are just smaller parts of the equity market today. And they tend to gravitate towards names that are larger, just generally have healthier balance sheets and maybe have a little more of a fundamental moat underneath them. So I think that's one of the reasons, just playing into the concentration of the equity market. The other reason, I think people are looking at markets and arguing that risk is being severely underpriced and therefore the market should be down a lot more, I think goes to the question of how forward-looking is the market and what is the market focused on? And so a really simple way to think about this. So if we look at spot oil prices, yeah, we're at $90. If we look at 6 months on the oil curve, we're at about $73. So that's still higher than where we were a few weeks ago, but it's nowhere near the percentage increase we've seen. And so the question we've heard a lot from clients, and you hear being discussed on the financial media, on social media, is how high will oil go and what will be the implications of various levels of oil prices for the inflation backdrop, the demand backdrop for the consumer, so on and so forth, for S&P earnings. And so what we think matters more than the price level is really the duration of the story. And again, a lot of people are saying the market's being complacent here because oil's at 90. But again, it really depends not on how high oil goes in the near term, but how high oil goes and how long it stays there. And so I would argue it's a better backdrop ultimately for the economy and for the market if oil spikes to 150 over the next 2 weeks, but then drops back down so that you're hitting a high level of 150. Whereas I would say what is worse if we move up to 125 over 3 months. That persistence is far greater than that $25 difference. So a lower oil prices over a longer period of time is far worse because it starts to get ingrained into the economic data, into the behavioral data, into the policy data. And so that's really the biggest risk. And in fact, if you look at the market multiple and you look at credit spreads and other measures of risk premia, there's been this huge disconnect between the front month oil contract of about $90 and a lot of these metrics. In other words, $90 oil suggests the PE of the market should be a lot lower and should suggest that credit spreads should be a lot higher. But again, that's only looking out 1 month. If we look at out the 6-month contract, it actually correlates far better with what we've seen in markets. And the difference between that, of course, is the view on the duration of this move in oil. So for all of you that think that the market should be down a lot more and the VIX should be a lot higher and credit spreads should be a lot wider, again, the question is not how high oil is going today, but how high will it be in 3 months and in 6 months? And obviously, there's still a fairly broad consensus that this will not last a long time in 6 months. Typically, geopolitical driven market sell-offs, particularly from oil, tend to be short-lived because, again, nobody around the world wants to see oil moving higher for a very long, persistent period of time. And these issues eventually get resolved fairly quickly because, of course, higher oil prices is a broad pressuring agent, if you will, on really everything except those that are selling oil, which is not the majority of the world. We think that's going to continue to be the case, and the markets won't act more violently unless we start seeing the middle, the belly of the curve, looking at 3 months, 6 months, 9 months, really start to move higher, and this backwardation move directionally towards a contango market, which would be a really bad situation. But again, those tend to happen more related to storage issues and other long-term things, which this hopefully will not be.
So we've already seen oil spike. And if that were to keep going, as long as we get a relatively short resolution of this, investors will be able and markets will be able to look through some of the economic data noise. But if it continues on for a long time, it's going to be much harder to ignore the effect of oil in the data for markets.
Yeah, and this is where that extrapolation component comes in because oil moves up, and then it's been a week, so no big deal. But if it's now a month and a quarter, then it starts to have a more ingrained impact on behavior and on the fundamentals of the micro and macro economy. So then the aftermath of that story takes a longer time to get unwound. Where if oil pops for a few weeks and then comes back down to a lower level, markets tend to generally look past any of the negative aftermath in economic data, inflation data, earnings data, because again, the reason we get that aftermath negative data is because of the previous spike in oil. And if the previous spike in oil is no longer the case, then markets generally look through that. And we even saw that with the tariff market sell-off. As soon as Trump paused, which I remember back then, we were just saying to investors that don't expect the markets to bottom because sentiment is washed out. I saw a bunch of other strategists earlier this week were making a bullish call and telling investors to buy the dip because of some either technical or sentiment reasons. But again, in a normal market that's not being hit by an exogenous event, yeah, that kind of thinking typically works. But when there's a single variable pressuring the market, really fundamentals, valuations, and sentiment go out the window. And we saw that with tariffs last year. You literally needed President Trump to pause the accelerating negative rhetoric around trade to stop the market's decline. And it did. And we've seen that in many various forms in other market sell-offs, like the summer of 2023, when interest rates were rising and the market was declining. And again, you could have looked at technicals and you could have looked at sentiment and you could have said, look, the market's looking cheap or these stocks are looking cheap. But again, the catalyst, as long as rates were going up, things were getting cheaper and people were getting more bearish. And that's very classic behavior. So in this case, it's very much the same thing. So we're waiting for some kind of event that makes it clear that potentially we've gotten to a peak in oil prices and a peak in concerns. And thus far, there's been a few headlines from the Trump administration about trying to secure insurance for some of these ships going through the Strait of Hormuz. But again, as long as there's still a lot of rockets and bombs crossing the sky, I think there's going to continue to be a lot of fear priced into the front month of the oil situation.
In these uncertain times, providing a framework, I think, is very valuable in a kind of context for how investors should be thinking about markets and what's ahead.
And then that's exactly a great way to wrap this up, is that I think we could offer a framework based on the behavioral reactions throughout history, and whether it's interest rates, oil prices, inflation metrics, or some other kind of exogenous shock hitting markets. The behavioral framework that you see in markets tends to be very similar. What tends to work or outperform in a sharply declining market, whether it's due to higher oil or higher rates, is generally lower beta, larger types of attributes. And then the moment that problem hits its peak, whether it's tariff rhetoric, interest rates, or in today's case, oil prices, you tend to get a 180-degree rotation. And what has been the worst goes from worst to first, and what was the best goes from first to worst. And this is the tricky part for investors and thinking about the duration of this, because if you're loading up on oil and getting really defensive within your mandate and basically positioning your portfolio for continued rise in oil prices and this being extended, as soon as that is not the case, you get an extreme whipsaw within the markets, and the outperformance that you created on the way up with oil prices could very quickly get wiped out. And so investors, I think, want to be really careful of creating portfolios that are too binary, driven by the price of oil. Our view, of course, is that we've had a soft landing in the U.S. economy, that we're beginning to see a broadening out of the macroeconomic data. Last month, we saw 90% of PMIs in the U.S. in expansion for the first time in 5 years. So what we've been focusing on is highlighting opportunities in areas of the market that have been hit because of this spike in oil, but that we think will likely be strong performers following the peak in oil prices. And obviously, there's a lot of uncertainty today, but we would argue investors should be looking for opportunities here to buy things on sale that will benefit from the longer term picture, which we believe continues to be a global cyclical recovery. And, what could disrupt that, of course, is if we had higher oil prices for a persistent longer period of time. And I'm talking about months and quarters, not just weeks and days. So we will continue to watch the situation as it evolves and expect a lot more volatility next week.
Thank you, Michael. And we'll pick this up again next week.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.